I'm very pleased to have Mr. Stanton Jones from ISG, who leads the ISG index research. Welcome, Stanton. And if you want to have some opening remarks, then we will open the floor for question and answer.
Sure. Thank you very much, and thanks everyone for taking the time. So I'm gonna share my screen and just do maybe about 3 slides or so on what we just reported out to over 1,000 investors, providers, our clients. We do this each quarter, so report on the state of the IT services sector. So I'm going to do a quick screen share. I haven't used Cisco in a while, so let me see. There we go. Okay. Can you see my screen?
Yeah, we can see.
Fantastic. Awesome. It worked.
Yeah.
Okay. So as I mentioned, we report out each quarter on the health and growth of the IT services sector. So I'll just show you a few of the slides, and we can jump into Q&A. So we like to kind of come up with 3 sort of key themes from the quarter. You can see those here. Number 1, we saw in the second quarter really strong contracting activity in the sector. It was primarily led by applications related work, engineering work, and industry specific BPO. And as we'll talk about here in just a minute, what really is not growing and is not driving growth in the sector is infrastructure, infrastructure heavy outsourcing, data center outsourcing. And so we saw that continue as a theme in the second quarter. The supply side of the equation really continues to be the biggest factor inhibiting growth and also impacting our clients. We believe in the sector, there's just continues to be extremely strong demand for talent. And so that's creating attrition related delays for our clients as they look to kick off projects and look to kick off transition related work, which is a key component to many of these multi-year agreements. You have to transition into these services. And we're seeing some pretty significant delays in some of those areas. And then finally, if you look kind of up from a currency perspective, FX is really having obviously an impact on the sector and is really the primary reason that we pulled back there's a big contributing factor for the reason that we pulled back our forecast for the full year. And we'll talk about that here in just a second. Just in terms of really high level results for the sector, we look at 2 big baskets. So we're looking at managed services. So think about outsourcing, multi-year contractual commitments, and cloud. So we're talking about infrastructure as a service and software as a service. If you combine those together, strong result for the quarter and for the first half, as you can see there on the left-hand side. But the main message here is that, and you'll see this reflected through a lot of our commentary, is strong year-over-year and half-year results. But if you look at things sequentially on a quarter-over-quarter basis, we did see some slowing. For managed services, we had our 5th consecutive quarter over 8 billion of ACV. As you can see there, 8.8 billion of ACV, very strong result. But again, relatively flat on a sequential basis. And then as a service up 27% on a half-year basis, but down sequentially, as you can see there on the far right-hand side. As I mentioned, really the number one thing that we are tracking in our sector is sort of the supply side and access to talent. This is just an interesting data point that we're working through with many of our clients, and that is that if you look at the amount of hiring that's taken place over the past 12 months, it's really pretty extraordinary, in some cases unprecedented. So we're talking about hiring to backfill for the elevated attrition that we've seen and hiring for growth. So when you smash all that together, you can see here that over a basket of 18 companies we looked at, providers under 5 billion, about 40% of those have been hired within the last year, and providers under 5 billion, almost 50% have been hired within the last year. Now, the reason that's important is there's lots of reasons for it, but if you look at it through the lens of as we're working with our clients, as they're looking for service continuity on their outsourcing projects, and they're looking to tap into talent, experienced talent, to launch many of these digital initiatives. That's a question coming up more and more is, how is a provider going to deliver that if half the people on my account are new? So we're still working through, obviously, the implications of what we're calling the Great Reshuffle. From a pricing perspective, really just two main messages here. On the left-hand side, you can see managed services. The main message there is that we continue to see unit prices for all types of services, whether it's infrastructure, applications, network, continuing to decline. That's been a historical norm that has been in the industry for many, many years. So that has not changed, even given wage pressure. The main difference here is that we've seen, in many cases, a slowdown in that decrease. That's the main message, is unit prices continuing to decrease, just decreasing at a slower rate. And then on the right-hand side there, you can see project-based work. That's a different story. We have seen some rate increases, and since in some cases, some pretty significant rate increases, upwards of 15%, specifically in India, and across the board, 4 to 7%. And then last slide here as we wrap up before we jump into the Q&A. In terms of our overall forecast, I did mention the impact of FX, and that's a big contributing factor as to why we pulled our managed services forecast down from 5.1% down to 3.5%. We can talk through in the Q&A a lot of the macroeconomic and geopolitical factors that are obviously impacting the globe. But the main message here is that we continue to see very strong demand across the globe for IT services, but we're also aware of and factoring into our forecast the impact of a very strong dollar and the impact that that's going to have on companies with significant business in Europe and in Asia Pacific. And then our as a service forecast, we pulled back from 21% down to 18%, largely for the same reason, for the FX impact. Okay, so that's it for the just kind of opening comments. So it looks like Steve has joined us. So hi, Steve. And I think just in time for Q&A.
Hi, Steve. Thanks, Stanton, for your opening remarks. Hi, Steve. Thank you very much for joining. So participants, if you have any question, please raise the hand, or you can write the question on chat box. I can read it for you. So guys, we'll wait for a minute for the question queue to assemble. But before people started asking question, very interesting wrap up of a very short period of time what you were trying to say. So some important question that is coming in my mind, if you, as you rightly said, that a large part of the guidance trimming that you did is because of the forex. So how as an analyst or as an industry person or as an investor in the companies, how one should understand this? Is it a loss of dollar for a client, or it is more of a accounting entry and you are cutting the number just because of the translation and ultimately it is not impacting the business? Or is it like this cross currency is actually impacting the business where the companies are losing the actual dollar? How to read this?
Yeah, I think it's a little bit of both. And first, Steve Hall, president of Europe, been on the index for a long time with Stanton. Apologies, I was trying to get in. It's a bit of both. So the first thing, when we look at the index and we look at the overall scale of global service providers, most of them report in US dollars, and most of the market looks at it from a USD. Now, globally, from a sourcing perspective, about 60% of the revenue comes from US for most of the service providers. Some it's a little higher. You'll see some it's sort of a 70-30, but most it's sort of 60-40. And about 60-40 split, about 30 to 35% of that comes from Europe. Given the pound and the euro performance and really what the Fed is doing to the, with the US dollar, money is clearly shifting in the US dollar, devaluing the euro and the pound. Yen's included in there as well. So we look at it sort of the broader impact on the sourcing business and sort of the investments across that. As Stanton mentioned, demand side is still high. So from a constant currency standpoint, which you're seeing everybody reporting in now, you're seeing good growth on a constant currency basis. So on that side, it's more of an accounting type perspective. But obviously, on a reported basis, it is going down. Our forecast is in a reporting basis. And so we look at sort of the percent of revenue from each of the countries impacted, where we see sourcing decline to make sure that we get our overall estimate. On the other side, though, organizations that have a higher percentage of their revenue in Europe specifically are seeing an actual decline in their revenue from on a basis because of the FX headwinds. Now, the good thing is that's primarily on retail. We're seeing a little bit of pull down in that, but not enough to really significantly impact the market on the second side of it.
Okay. So, if I may know, guys, how much of this, let's say that 3.5% to 3.5% number, or the 21% to 18% number, how much is because of this cross currency impact, and how much is because of the loss of business? Or are we saying that this recessionary the pressure that we are hearing, or the global companies are talking about their pressure on profitability, it is not impacting the volume of the business at all?
It's very little impact on the demand side. We're seeing incredible demand at the top side. I mean, as Stanton probably shared with you, we've had 5 quarters of 8 billion plus. So last quarter we saw 8.6 billion of ACV awarded. In order to hit the numbers that we were going to have to hit, we would have to have two more quarters of sort of 8.5 billion per quarter of ACV awarded, which is phenomenal. Now, we think the demand is there. So we said FX is impacting some of it. It's interesting because, we're hearing a tremendous amount of the CPI and the inflation and concerns about recession. But quite frankly, we're not seeing that carry out in technology spending whatsoever. I just got off a call with a client on the banking side where we talked a lot about this. We do not see the impact at all kind of coming down. So while everything looks to be a concern, it's definitely not impacting the demand side on technology spend.
Sure. Thank you very much. We have question from Ayush. Ayush, please unmute yourself and ask the question.
Yeah, hi. So am I audible to you?
Yeah.
Okay, so thank you so much. So as Devashish has asked about the recessionary phase, so I just wanted to have a follow-up. So do you think the large deals are coming back again when the cost takeout is a major agenda on the table during the recessionary phase?
Yeah, I'm going to answer the backside of that question first. First, I think cost optimization is going to be a very big part of the next 2 quarters, maybe even 3 quarters. And I think what you'll see is people taking a look at how they can continue to use outsourcing and different delivery models, even automation, to reduce their base costs. That doesn't imply, though, that large deals are coming back. One of the things that Stanton did some great research on several quarters ago was sort of the impact of the mega deals on the overall business. And what we saw, if you go back 2 years, 3 years, mega deals used to account for about 20% of the total ACV that was awarded in any given quarter or in a year. Today, that number's down to sort of 12%. For a host of reasons, more has to do with the cloud and infrastructure type deals than really the sort of the global economy. So I would look for deals sort of in the 40 million and below. So call it 15 to 40 million range versus the 50 to 100 million, or certainly the 100 million range. Now we did have I think 9, Stanton. Was that correct? Was that the right number for the quarter? I don't have my notes in front of me.
Mega awards in the quarter? Yeah, it was 9. Yep.
Yeah, so we had 9 in the quarter in Q2, but 2 of those were kind of odd because they were 10-year BPO deals. So, and we didn't, there were some oddities in them. So we do see some mega deals, but we tend to see more in sort of that 40 million and below range now than we had before. Again, because of what we're seeing on so much of the infrastructure spend move to the cloud.
Great, thank you so much.
That answer I use?
Yes, thank you so much. So, and just next question, and again, I'll fall back in the queue. So my second question is towards attrition. So right now we are seeing that attrition is, is reporting on the downward trend for almost like all IT service providers. So how should we read this? So is it like through the demand slowdown, or is it like from the supply side a normalization?
Yeah, we got an amazing chart on this that Stanton will probably bring up as I talk. There's a couple things. First, we think attrition is finally slowing down. When we look out ahead over the next several quarters, we see it actually getting much more in balance. The trailing 12 months has obviously been incredibly difficult on the industry. The bigger metric that we looked at, though, is for organizations, what's their real churn? How many new people? What's the percent of their resources that have joined the firm over the last 12 months? For firms under 5 billion, that number was 47%. So 47% of their resources had joined over the last year. For firms over $1 billion, so you're talking TCS and Wipro and Accenture, I'm sorry, I got these wrong. 47% was for the firms under 5 billion. Above 5 billion, it was 40%. So if you look at those firms, 40% of their resources have joined in the last year. That's a lot of cultural change. That's an awful lot of change. So instead of calling it the Great Resignation, we're sort of calling it the Great Rotation now. It's really, people are just changing jobs sort of at mid-levels and senior levels of organization. Where we've seen the impact in the slowdown, quite frankly, has been on the demand side. So the client side, because they're also going through similar things, and some of the decision making has been slowed down. That being said, though, we still see really high demand, and we're working through the attrition issues. It has not been easy. I think that the challenge for the service providers and for the analysts out there is, I think we're going to continue to see margin compression. I think we're going to see a lot of pressure on the margins. The salary increases that we're giving, the wage increases that we're giving, the number of increases that we're giving. I mean, we're still hearing twice a year in India, call it 8 to 16, 8 to 12% each time. It's just not sustainable long term for that. Now the margins are being held up with still a lack of travel, less visa processing, SG&A, all of those have compressed, which is holding up the margins. But you look at that salary line, and you got to get concerned about the salary line doing what it's doing right now. What's that going to do to longer term margins?
Yeah, I think it's also important to keep in mind too, just the volume of people that have both gone, either been through attrition or are just net new additions. So for example, I'm just looking at some data, and this is publicly related data that we then model. So for example, Accenture's at 710,000 employees today. About a year or so ago, they were 625. So that addition that they have added, right? It's to accommodate for growth, but it's also attrition. And so we're talking about hundreds of thousands of employees that have changed jobs, right? A lot of these are freshers, obviously, coming in. So it's important to keep in mind, if you see that slowdown, it's not necessarily reflective of slowing growth. It's also backfilling the people that have left. And there's a lot of people that have left. So it's pretty extraordinary if you look back, and we're actually looking at this data to go back to see have companies ever been through this before. On the whole, as Steve just mentioned, the bigger companies, if you go back, over a decade ago, some were close to this range in terms of hiring this many new people hiring in a year. What's really interesting, though, the smaller firms are not. Nobody's even in the ballpark of, having turned 50% of the company in a year. Not turned, but, having those folks added within 1 year. So that's obviously, again, looking at it through the lens of, as we help our clients through this transition, the primary lens is, are they going to be able to deliver, and are they going to be able to scale that unique value proposition that we bought?
Thank you so much for the detailed answer. I'll fall back in the queue again.
Thanks, Ayush. So participants, if you have any question, please raise the hand. So guys, one related question that I have, what we have just discussed. One of the things that I have noticed in the recent quarterly results, especially with some of the large size Indian IT companies, they reduce the number of people onboarding and make dependent more on subcontracting. So do you think that it's a right strategy at the mid of such a long structural demand cycle? Do you think it's a right strategy, or should companies continue to move more towards hiring and not dependent on subcontracting cost? In fact, they should look the way to reduce the subcontracting cost now on.
It's a really tough.
Go ahead.
Go ahead, Stan. Why don't you go first, and I'll follow up.
So it's It's again, as we'll talk through this, there's so many factors at play here in what's happening in the industry right now. In many cases, the reliance on some contractors is purely a function of skills, needing specific skills to be able to meet demand around analytics and cyber and data engineering and cloud engineering. So that's a lot. So oftentimes there is no choice other than to tap into that subcontractor market in order to get access to those skills. But I think it's also a reflection of, providers are not going to subcontract their way to growth. They have to build this talent. And so that's why it's interesting if you kind of go back and look to see who started hiring earlier out of the pandemic, which, it seems like a long time ago, but if you start to go back and look to see who sort of recognized this massive spike in demand early, that's really where, we believe at the scale we're talking about here, they're going to have to build the talent, not necessarily, of course, through targeted M&A. Some use of subcontracting is going to solve short-term needs, but ultimately they're going to have to build this talent. So that use of subcontracting, while in the short term, is going to help to meet specific demand around specific skills, obviously is not going to be the long-term sustainable solution. But that's really why, we believe you're seeing so much of that it's to get access to specific skills that they don't have potentially in-house or have not yet fully built out in-house, even though they're in the process of building them out, but they're not ready to be fully utilized on client projects.
Great.
Yeah, and I think there's a regional play in here as well, very much so. So when you look at some of the, play local, go global strategies that a lot of them have, you'll see a concentration of subcontractors in some of the local locations that they have. Some of the new operating models are changing their delivery models. We're trying to get it back where it's still heavy offshore, but there's been, if you think of Agile and Pod and some of the things that we talked about, that's required a higher on-site presence in some cases. So they had to do some hiring there. And I think, quite frankly, there's two factors in my mind. There is a bit of this uncertainty, right? There's still demand is high, but we've got all these macroeconomic headwinds. How much talent do you want to bring on if you're going to have to lay that off at some time versus having some percent of your business as subcontractors? So to me, that's actually a fairly good hedge on it. And I'd look less at the margin difference versus the hedging, and do they have some room in there to do it, which I see quite a few of them are building just a bit of a hedge on their, their cost base to be able to do that and quickly get out. And then as Stanton said, the talent is really big, but I think just the recruiting. I think when I look across our business and so many businesses right now, the number of people that had to be recruited was overwhelming even some of the biggest firms' recruiting capabilities. So reaching out to a broader market to help with that recruiting brought in a lot of the subcontractors, which will be right to hire and some other things longer term.
Excellent. One question that one can really try to understand. So it's a kind of dilemma for me also. When we talk to people like ISG, Gartner, IDC, we always hearing about that pricing is something where clients are very, very accommodative to hear. There is an increase in pricing. In certain cases, it may be as high as 15 to 18%. But when we see company numbers, when we speak to companies, there seems to be a difference there. Now, what I'm trying to understand is it like, let's say some Indian players or global players, are they using price as to gain market share in such high demand scenario, or it is like that, it's more of a concept that pricing is going up, but it's at the ground level, it is not going up?
I think it's more of a weighted average is what you're seeing right now. So when you go back to Stanton's charts on the pricing impact of managed services, those are 3 to 5 year deals, and you're seeing very little impact of that. And most organizations are thinking that there's still productivity increases, right? They don't quite equate managed services to just labor and just the labor component of that labor. This one right here. So if you go to some of the big players and you say, let's assume 50% or 75% of their business is managed service, there's going to be very little price variability in that. And that's sort of going to be under that 4% right now that we're seeing. On the project side, you're going to see some of those pricing things come through, as Stanton mentioned, and we're seeing that. But if that's only 25% of their total portfolio, the managed services business, so you almost got to say what percentage of your business is, managed services versus, project based. Similar, quite frankly, the way we were looking at digital several years ago, because we all had this premise that if you were out there doing digital work in air quotes, that the premium on that would be greater, thus your margins would increase, you could get more price through and be able to carry that through. One, I don't think that premise ever came to fruition at scale. There was still a tremendous amount of downward pressure on it. But two, it still remained a fairly smaller percentage of their overall work, their overall work makeup, which kind of, when you looked at the blended, it kept it down. So you weren't seeing those 12 to 15% increases that the market would be talking about. It was much more. Sometimes I'm seeing it. It's not even in the 2 to 3% range, quite frankly.
I think it's also important to keep in mind that, on the left, even on the left-hand side, on the managed services side, right, we talked about the fact that we continue to see unit prices decline just more slowly. So thinking about this through the lens of an outsourcing buyer, the expectation is my price will reduce over time. But it's also important to keep in mind there's also a spectrum within managed services. If we're talking about commodity services, so for example, infrastructure outsourcing or workplace services, right? The expectation there is that those prices will continue to decline, and the service provider is going to find ways to be more and more productive to deliver those services with more automation in a lower cost location, right? That's very clear. If you move farther to the right, and for example, you're moving more into an application centric agreement, and there's a lot of application related transformation in order to get to the long term, the steady state, right? Then in that case, there is likely going to be more of a FTE based, name resource based approach in order to get access to the talent that you need to be able to transform those applications. And therefore, the components of that are tied to that, those prices may reduce less. There may be a portion of it that is more of a staff augmentation type approach that will be then applicable to some of these rate increases. So it's also just important to keep in mind that it's a spectrum. And as Steve mentioned, ultimately, a lot of it depends on the mix, the portfolio mix of the service provider, the degree to which it's outsourcing versus project-based, and then within outsourcing, the degree to which it's commodity versus more strategic.
Excellent. I have a few more questions in my mind, but I will fall back into the queue. We have question from Sapna. Sapna, please unmute yourself and ask the question.
Hello?
Yes, Sapna, we can hear you.
Yeah, hi. I joined in a bit late, so I'm not sure if I'm repeating the question, but my question was more on the demand side. Like you said, that we are at a juncture where we are seeing uncertainty in the macros, whereas the numbers that have come across now in the tech pack has been pretty decent. So, and rather a mixed bag on the margin and revenue front. So, can you just take us through the demand trends more on discretionary and non-discretionary side and vertical? Industry-wise, as to where are we seeing the pressure, or where is there a red flags that we'll see some slowdown in terms of verticals? I'm not sure if this question has already been answered.
That was a great question. And you pulled the onion back on a couple things. So geographies and verticals and industries and discretionary and non-discretionary, right?
Yes.
Okay. Stan, you want to take it first?
Sure. So why don't you know what, Steve? Actually, I'm going to pull up the industry slide. Why don't
That's
you
what I was thinking
take
exactly.
off, and then while I'll pull up the industry slide.
So again, Swapna, as we said at the beginning, the demand is actually at all-time highs. We've had 5 quarters with demand sort of over 8 billion of ACV per quarter. And we're seeing just tremendous demand in the market right now. The demand has certainly changed, though, over the last year. And the industries or the work that is actually leading everything right now is really applications, engineering, and industry specific BPO. Those three are all connected because it's really the driving of digital transformation that you're seeing finally called through the numbers, and software sort of becoming everything. The piece that we see really declining or very flat is infrastructure. So organizations that had really invested in remote infrastructure management are heavily investing into cloud and cloud management, hybrid cloud, all of the hyperscalers, even some, private cloud solutions. The cloud, so when we look at it as a percentage of ACV on a quarterly basis, movement to the cloud now accounts for 90% of the total ACV that's awarded on a quarterly basis. And that's massive. So the infrastructure is the piece that's really been impacted that. So even though the business has changed and growing, that growth is very different. Now, when we look at the managed services piece, and we always got to be careful because this is just for a half. Financial services has been way up, telco has been way up, and travel and transportation have all been up significantly. So that's sort of the traditional outsourcing components of the market, players in that. Financial services is typically 35 to 40%. It typically hangs right around 37%, but call it in the range of 35 to 40% of the total market. So for that to be up 35%, you can see the positive impact on the market. Retail and energy tend to be fairly low as far as percent of outsource and their impact on it. So they're down, but there's multiple reasons for that. We expect energy to actually climb. We think energy is going to be a great sector going forward because of IoT and analytics, certainly ESG, and all the engineering work that's taking place in engineering. Manufacturing is the second largest. Manufacturing is typically somewhere between 25 to 30% on a quarterly basis of the overall market. We have the arrow going down, but it was essentially flat over the last half. Most of that flatness was really due to the supply chain issues that we saw and just some pullback on some projects not being moving forward. As energy crisis, especially in Europe, and I live in London, so this is top of mind for me. I think energy and manufacturing are going to be tough in the second half, but I think there's going to be a lot of cost takeout and a lot of different plays for the outsourcing providers in those two specific sectors. Pharma is interesting because I think on the life sciences and device manufacturing side, I think, again, that's an area where you're going to see quite a bit of investment. And on the healthcare, especially the payer side of the insurance business within the US market, we're seeing really healthy growth there as well. So I think that one will return. This is I always talk about this slide of the index. It's one of my favorite slides because it does sort of give you one page, sort of what the market conditions are, and then we can have a conversation of what it really means. So, Stan, anything else from you?
No, I was gonna say, do you want to do quick regional update, Steve?
Yeah. I mean, just real quick. So EMEA, quarter over quarter was relatively flat. Year over year, though, half year up 20%. Managed services was up a little quarter over quarter. Again, year over year comparison, though, up 8% and pretty healthy as we look through that. The as a service market has really taken off finally in Europe. So we're seeing the cloud business really grow. I think the cloud business is clearly growing faster in Europe now than it is in the US. That's as much the law of large numbers than anything, though. I mean, both markets are still really expanding. And the UK market, which is, a very large percentage of the total EMEA market, it's really UK and DACH that drive the market. UK was over $1 billion of ACV for the 4 out of the past 5 quarters. So everything sort of around Brexit hasn't really impacted that market at all. Financial services still remains really strong. And quite frankly, France has become a good market in the EMEA standpoint from the number of deals. So look for service providers that have a good footprint in France as well. And the other thing I would say is anything in the public sector in Europe, the EU public tender process is just on fire with the amount of money that they're investing, not only sort of post-COVID, but just building back and things. So we're seeing that in the Italian public sector. We're seeing it throughout Germany. We're seeing it throughout France, really across the countries. We're seeing a lot of public sector dollars being applied and service providers growing in that space. Americas, again, good growth on the Americas. Year over year, it was sort of, 4.1 to 4.1, so relatively flat, but on the half year, good growth, 11%. 42% on the half side. Again, you can kind of see sort of flat Q1 to Q2, good growth over 2Q 2021. I think the good thing about the Americas market is, again, you can just see the magnitude of it. Over 12 billion. ACV up 20%. So good growth. We did see a little bit of dip Q1 to Q2. Not overly concerned about that. We don't think that was a macro thing. We just think it was some of the larger deals that were there and a tougher compare. But you can see the great growth from previous. Asia Pac sort of down. Asia Pac is an interesting market. This primarily reflects on the managed services side, really the swing in Australia, New Zealand, a little bit of Japan. That's the bulk of that market. Again, it's about $1 billion market. It dipped a little bit, but it's, overall on the first half, it's pretty good. The as a service market had a really big dip, but this was really a reflection of the hyperscalers in China. So Baidu, Alibaba, Tencent, and a lot of the pressure on the market in China, the regulatory environment in China. And I think it was 1.5 billion, if I'm not mistaken, of an ACV drop just in that market. So certainly some concerns with the Chinese hyperscalers over the past several quarters. So did that answer the question?
Yes, very much. Thanks. I'll come back in the queue.
Nope, you are welcome.
I think you're on mute.
I'm sorry.
That's okay.
Two more questions before Swapna fall into the queue. One is related to the definition of discretionary. Okay, especially when you talk to somebody in India, they will always say that larger is always good. Bigger companies do better with much better margins. Smaller companies, they are vulnerable in nature, dependent on few clients. So that's why in a current recessionary scenario, they may face a lot more challenges than larger guys. My own perception is that definition should change. That definition of discretionary should change. The definition of smaller companies, just because they are small or they are dependent on few guys, we cannot just say that their dependence on discretionary is high and that's why in a recessionary period they should not grow. So is my understanding correct? And if you can throw a few more lights in these areas.
Sure, I'll go first, and then I know Steve has an opinion on this as well. So yes, I agree with you, and I think it's really, really important to keep in mind how much things have changed over the past several years and have been really accelerated by the pandemic. In the past, when we would think about things like discretionary and non-discretionary is I have to keep my ERP system running. Discretionary is I need to upgrade my ERP system. If your ERP system's running in the cloud, I'm not going to say you don't need to upgrade it anymore, but a lot of that's already upgraded for you, right? So there has been can you guys hear me okay?
Yeah.
Okay, sorry, I got some feedback there. So there has been a fundamental shift in the underlying technology of how much of this happens because of cloud, as Steve talked about. A huge amount of workloads running in the cloud now, but it still represents a small portion of the overall portfolio. If you think about many of these big mainframe-based applications at banks and insurance companies and retail, But there has been a fundamental shift in the underlying technology platforms that are used, which has changed the nature of the way the IT services sector addresses the opportunity, which means that changes that discretionary versus non-discretionary. And accelerated by the pandemic is the fact that technology is now central to just about every company's strategy. And I know it sounds kind of mom and apple pie, but it's true that technology modernization now is core to companies' survival. So that old model that we've used versus discretionary, non-discretionary, I completely agree with you, needs to go away. And now it's more about which technology platforms and the degree to which companies are modernizing applications onto those platforms, and where do providers fit into that ecosystem. That's the new way, we believe, to look at it. Steve?
Yeah, exactly right. I almost don't even like saying discretionary and non-discretionary more, because like CapEx and OpEx, they have very different meanings for most organizations now. The last part that Stanton said was really the most critical. Tech modernization and tech spend has increased across every company, across all aspects of the country, their enterprises and their companies. They can't separate anymore between what's discretionary spend and what's not. Where analytics or BI projects is a great example, used to be discretionary, now they're core and so critical. Consumer behavior has changed so much that CX is now critical to the life of a firm. So I would agree with you. If firms say they can only grow because of discretionary, then quite frankly, there's probably better investments out there, because enterprises have to do both.
And that's why I think it's important to be kind of the new lens to be looking at this through, is less about broad brush discretionary versus non-discretionary, and more focus on many of the service lines that we've talked about. Applications related work, applications related transformation, engineering related work as products turn into services, industry specific BPO as banks and healthcare companies and energy companies look to dramatically increase the speed and pace at which they execute business processes specific to them. For healthcare, revenue lifecycle management, mortgage processing, those kinds of things are, what is driving much of this ACV growth. And you can argue, neither one of those are discretionary, non-discretionary. Those are things that companies need in order to grow and sustain and survive. And so therefore, that's kind of the new lens to be looking at it through, rather than, discretionary versus non-discretionary.
Understood. Another thing that I have in my mind is, let's say the hyperscalers performance. Two parts of my question. One, if you see the B2C tech spending, the adoption of technology at the B2C level, at least in last 2 quarters, we have seen a good amount of impact there. We have seen Facebook getting impacted, Netflix getting impacted. So do you think that at a B2C level, the adoption of technology or the speed of adoption of technology has kind of come down, and whether that is expected to impact the B2B technology adoption also, if any?
I'm laughing because we've had a lot of good debates internally on this exact topic. And one of our quants that's just brilliant with numbers has been saying that to look at the hyperscalers and the growth and the impact on GSIs and the next level of impact, you've got to really take a look at what's happening on the consumer side and Netflix and some of the others. So we've had a lot of debates. Stan, you want to explain the chart, because I know this just came out just 2 weeks ago.
Right. So the short answer is it could impact the IT services sector in the long run. Yes. Without going through the workflow to get there, yes, the answer is it could. Is it today? No, it's not. The thing that we are tracking is, if you look at this chart here, so we are tracking slowing growth rate for the hyperscalers, as you've identified. There's lots of different reasons for that, and you can't also, it can be tricky sometimes, because if you put them all into the same basket, that can be little misleading. AWS obviously has a huge business and growth around startups, for example. Microsoft has much more of a enterprise exposure. Google Cloud has been laser focused on industry specific, workloads, and especially in places like in banking and insurance. So they all have a different approach and different profile. But the net here is growth is slowing, or has been slowing over the past couple of quarters. I think the important thing that we are watching and important to keep an eye on is if you also look at the earnings calls, for example, of many service providers, you're going to hear more and more the degree to which their pipeline is influenced by hyperscaler relationships and hyperscaler related projects. We are both tracking the data and also as an advisory firm working, in between all three of those, between our clients, the hyperscalers, and the service providers. And there absolutely is a challenge here where many enterprises have signed up for what's called a framework agreement, right? A commitment to spend X with a hyperscaler over the next 3 years. Many of the easy workloads have already been moved. As I mentioned earlier, we're now kind of moving into the next phase, which is like the heavy lifting phase of getting a mainframe out of the data center, and not the whole thing, but certain applications off that mainframe into the cloud. And those are big and hard projects. And it's not just a technology play, it's an organizational change and a big financial change. So these are big, heavy lifting projects that require design, development, organizational change, executive leadership. And so in many cases, we are seeing cases where that is stalling, and enterprises need a lot of help to get those incremental workloads moved. That said, we do think it's going to take time for this potential slowdown to affect the sector. We're not saying yet that it has or will. It's just, it depends. If it continues to slow, it could over time, impact the services sector because of the linkage between those GSIs and the hyperscalers.
And just to give you guys a counter view, so just like analysts, we argue a lot internally as well because it's healthy, right? What I see is the demand is so high at the enterprise level where the GSIs tend to play to adopt cloud technologies, to adopt analytics, to adopt IoT, and really work with the hyperscalers, that even if there's a slowdown on the consumer side, so the Netflix of the world, it's not necessarily impacting the enterprises that are, driving that way. So, I would be more concerned about major changes to the regulatory environment or data sovereignty, those types of issues, which could impact the growth of the public cloud versus whether or not Netflix subscription service. That will certainly impact AWS and Azure. I'm less concerned in the near term about the impact on the GSI's enterprise clients. And that's sort of the discussion that we've had internally on it.
Excellent. So should we kind of think like we are moving into a scenario where actually that GSIs will see more growth from cloud adoption because of the mainframe shifting and all that you have already explained? Or should we think like this way that, or is there internally, do you guys have any multiplication in your mind that this much spend with a hyperscaler will convert into this multiplying revenue of a GSI, or would it take this much of time?
We've tried, and because we used to always have a multiple for ERP, for example, right? You pay X for SAP licenses, it was going to be 7 to 8X on services. We haven't got the math right on this. We know for SaaS, the multiple's much lower, right? You spend, X on, a SaaS product, and it's X minus something on services, right? It's like 0.7 or something. So you don't get that big multiple and flow through. We don't know what it is on cloud yet, quite frankly. And we don't think it'll be 1 because that just doesn't make sense from the overall market. But the hyperscalers are definitely aligned with the GSIs to really grow growth and with the GSIs. The GSIs are all aligning with the hyperscalers to do it. We know that there's this massive industry-specific, domain-specific change going through, which should help the GSIs. But you know what? We're going to continue to work on the math on this and what we think those ratios are, and hopefully have something on the index, maybe by the end of the year, maybe not, but there's absolutely a correlation there, and it's a strong correlation. We just don't know what that factor is yet.
Yeah.
But
Yeah, I think-
qualitatively, do you think
Sorry.
that we are moving into a scenario where GSIs will get more businesses, or the growth for GSIs would be higher from here on because of the mainframe shift or heavy lifting that Stanton already mentioned? Do you think that that is what the scenario would be going forward in next 2-3 years?
I think the next 2 to 3 years, the overall revenue for GSIs is going to accelerate, and it's going to climb. Absolutely, for a host of reasons. I think the number one reason it will, though, is spend is coming from so many areas other than IT, right? For the longest period, the majority, call it 75 to 80% of their revenue, really came from IT spend. BPO was maybe a little bit, and then you had a little bit outside. Now we're seeing tech spend across the enterprise, and business units are controlling apps, and that's coming in. Analytics are coming in. Engineering is coming in a big way. And all of the major service providers and the tier twos that we all monitor are all taking bigger and bigger pieces of that. And the cloud is a very big part of the enabler of that. Because they're moving to the cloud, because they're moving compute there, they're able to take on these other projects in a much more compelling way. The mainframe may have a little bit of it, but I think it's that broader trend that's overall moving the needle.
Excellent. So another thing that you have just touched upon and we have not discussed much about is the ER&D space. That is one area, at least I have not seen the kind of traction that I am seeing with ER&D companies in India with margin resilience. That is something very, very important. We have not seen in the past, at least with Indian companies. So normally what I have seen in India, that in ER&D is a very vulnerable one, very, very volatile in nature, very, very different from ER&D, IT service companies. In a high demand scenario, normally they become the poaching ground for IT people, and that's why their attrition shot up to the roof, and they have a significant margin pressure. But this time we are seeing the story is little different. ER&D players are reporting attrition which is much lower. They are reporting margins which is better than IT service players. Their resilience on margin is far, far better, and they are consistently delivering better than IT services. So what has changed in the ER&D space, and how do you read all these indicators?
Yeah, I mean, the ACV has doubled on an annual basis for really the last 2 years for ER&D. And I think the big change was, all the way back to the famous quote of software is eating the world. And so if you go back to engineering, you saw this massive rise of digital twins. You saw a really big rise in IoT. PLM systems had to become more sophisticated as they went through. And software was becoming the dominant theme on the engineering side, not just sort of CAD/CAM, but really software engineering was the core. Whether it was in vehicles or washing machines or anything, it was software embedded in everywhere. Organizations tried to do that themselves. They recognized a lot of things. One, they couldn't get access to the talent. They didn't have the software disciplines in their engineering organizations that they did. IT couldn't scale to be able to do that. And quite frankly, if you look at the changes of Volkswagen and their leadership changes recently, a lot of that was sort of their, I don't want to say their failure, their difficulty transitioning to a software organization. So those engineering organizations really turned to the broader market and really said, who can really help me more broadly? So you saw, obviously a lot of acquisitions in this space. Obviously, you saw Global Logic and Hitachi. You saw Altran and Capgemini. You saw DXC and Luxoft. EPAM has been doing well. But then you also saw organizations like HCL and Wipro and TCS that had strong engineering culture that were able to build those capabilities back up. And it's the one area that I'm most excited about, quite frankly, across the market, because it's completely untapped. And in many ways, the engineering spend is 3 to 4x what the IT spend is. And when I work with clients, on a product, I'll say, R&D intensity, so the amount of spend that you have to bring a product to market, it's 17 to 20% on an ongoing basis of that product's revenue is what you're going to spend on engineering. IT in a bank is like 7% of revenue, right? Manufacturing is like 2% of revenue. So you've got a much greater multiple on what you can do on the engineering side. And the more that goes to software, the more bullish I really am on the services side as that grows. And I'm finally starting to see the numbers to sort of justify some of that bullishness.
Excellent, excellent. I think I am done with my questions. Participants, if you have any questions, please raise the hands. We are almost coming close to the session. I think, guys, we have discussed most of the things, and I think we have covered most of the things. Do you think that we are missing something that you guys want to cover at the end of the session?
Stanton, anything?
I don't think so. No, I think we covered it. It looks like maybe we just got we got 2 questions in.
Oh. Yeah, please, Swapna, go ahead.
Yeah,
Swapna, please.
yeah. So yeah, my question is on ER&D. You spoke about how it is going to grow at a faster pace, and the spends are 3 to 4x versus what IT spends are. So in this case, in automotive is clearly, we have seen the softwareization of the automotive. But could you also highlight some of the areas? For instance, defense, etc., or any other verticals where you think that there is more of adoption and there is more of scope where the softwareization has not happened, and that is picking up much faster, just like automotive. And also, my second question is, since you spoke about Volkswagen, so do you think that now they are collaborating with the IT service providers the outsourcing is increasing, but do you think the captives here will also gear up in the meantime, given that the software is becoming core to them, because it's more of a software now versus what it used to be. So a product like automotive is more a software now versus what it used to be. So you think there'll be this outsourcing trend should continue the same way and it should gallop more, or you think that the captives also will accelerate in a similar way?
Yeah, we are seeing a big interest again in the captive space for exactly that reason. I think on the software side, on the engineering side, many organizations believe that that's core. So they either want some sort of VC, venture approach with it. They want some sort of captive, maybe a build, operate, transfer, but more of a captive. I think a lot of the organizations, though, are equally concerned about the attrition and the challenges globally right now on building out their own captive. The ones in Eastern Europe are, obviously a bit of a concern just from a geopolitical perspective. You'll hear organizations, especially in Europe, talk about Spain and Portugal. In the US, they'll talk about Mexico and Central America and maybe Argentina. None of those places have scale. They all have issues with monetary policy or geopolitical issues. So it still sort of leaves India as sort of the best choice, really for those large scale captives. So anything in manufacturing is absolutely a growth on the engineering side. Life sciences is a big growth area on the engineering side. We're seeing growth in aerospace and defense, quite frankly, and some of the defense side is even coming to the service providers to be able to do it. I've got multiple deals right now in that space. I would, what's interesting, we've talked about smart cities and smart buildings and smart locations for some time. I think that's finally actually taking off. We're working with multiple locations that have really embedded smart cities, and we're seeing the service providers and the GSIs a key part of that whole ecosystem to be able to go forward. So I would look at that space as well.
Yeah, and one more question. We I skipped my mind. I'll just come back. You can take the next question. I'll come back on this question. Yeah.
Now we have just completed our stipulated time. I think we should end the session.
Yeah.
Okay, no problem. Oh, yeah, that's okay.
Yeah. Okay, guys. Thank you so much, everybody, for participating in this conference, in this event, and thank you, ISG guys, for explaining things so well in so detail. Thank you very much for your time, and have a good night.
Great. Thank you.
Okay. Thanks,
Thank you.
everyone.
Take care.
Bye.
Bye.